All right, guys, welcome. Really appreciate everyone joining us this afternoon. My name is Jack Bevere. I'm going to share my screen here and kick things off. So just wanted to remind everybody, I'm going to make this basically a pretty brief presentation, 15, maybe 20 minutes on the outside. Talk about just some of the things that I've been thinking about as I read what's going on in the world these days, and we think about our own single-family real estate investing business. And just wanted to kind of share some observations and then thoughts, but wanted to be really kind of a conversation as much as possible. So please don't hesitate to use the chat feature here and ask any questions during the presentation. I'll try to address those either as I see them or at the end. We'll have a Q&A section at the end. And then if it's a question or something, a comment that you want to make at the end, that's too much to type out, just raise your hand and we should be able to unmute you and kind of make this more of a conversation. So want to keep it informal and brief on this Friday afternoon, and but look forward to kind of sharing some thoughts and getting you guys feedback as well. My name is Jack Bevere. Just a brief introduction. I'm a partner at the Dominion Group of Companies, which was founded in 2002. We are single-family real estate investors. We have a couple different companies. Dominion Properties buys and renovates about 100 houses each year. We have a set of rental companies where we own our own rental portfolio. We're up to about 750 single-family properties. We have an in-house property management company called Dominion Management, and a lending company that lends nationally to single-family real estate investors. We do both fix and flip loans as well as 30-year rental loans to landlords that are building their rental portfolios. I came into the company in 2007, doing acquisitions, and became a partner in 2008. And since then, my partner Fred Lewis and I have been growing the platform, and so we think about these issues constantly. We're always trying to stay ahead of the curve, figure out how to bob and weave as the market moves. And the past 15 years has been a very exciting time, and I'm sure the next will be as well. So let's hop right into it. As the kind of the teaser for this put out there, inflation has been a big conversation of late. So I got a ambulance going by. My office is in Baltimore, so goes with the territory. So we've seen inflation this year. A lot of that has had to do with the COVID pandemic, and it's very fair to say that inflation is upon us. Whereas for the past 10 years, inflation's hovered around 2%, which has been congruent with the Federal Reserve's target. Over the past year, we've seen as much as, or up to about 6%. And so at this point in time, with not the pandemic over, but certainly we've made a lot of progress on that front. A big debate right now is whether this inflation that we've seen is something that's transitory and it was just, COVID issues and everybody's going to get back to work and the supply chain issues are going to work themselves out and prices are going to come back down. Or has COVID caused kind of a permanent shift and we're going to see inflation continue on a going forward basis? Or along the same lines, was COVID really the trigger to uncover issues that have been boiling, simmering in the U.S. economy for a long period of time, and now we're going to have inflation to deal with because that's chicken's coming home to roost. So, really since the summer and particularly into the fall, this transitory versus permanent inflation debate has been a big one, and the jury is far from in on this issue. Every week there's new articles in all the financial periodicals about this issue, and there's definitely no certainty on that side right now. I want to bring up, I found this infographic from John Burns Consulting, who's really very, very popular real estate consultant for builders and anybody who's really placing money institutionally into real estate. And he came up with a nice infographic, particularly speaking on this issue of transitory versus persistent, and what the different views are for each of those camps on the supply, demand, and what the conclusions are. So, if you think that this issue, and each of you, I'm sure, has an opinion, on this subject. If you're on team transitory, you think that the COVID-induced slowdowns in materials, manufacturing, and transportation are going to work themselves out over the next 6 to 18 months. This was just a late 2020, 2021 thing, but everything's working itself out. Truck drivers are going to get back to work, and prices are going to come down, like lumber and OSB did a couple months ago in a quick and significant way. If you think that inflation is going to be more persistent, you think this is going to be a problem for the labor markets, and labor is going to be undersupplied for this foreseeable future because we have low immigration and an uptick in retirees. There's a demographic issue here, and it's not being backfilled by any kind of workforce development in any material way. And so you think that this increase in labor costs is going to cause permanent inflation, and it's something that we're going to have to deal with for the long term. And of course, you could see logic in both of these things, right? Like there's a middle ground here. I'm probably, getting ahead of myself, but I'm probably I agree with the transitory issue. I agree with the permanent persistent issue. But there's ramifications for your investing business either way that we should all be thinking about. On the demand side of things, if you think that inflation is transitory, you think demand's going to slow down. We've gotten a bunch of savings because no one was spending any money because of COVID, and we all got a bunch of federal stimulus money. And as that money is spent, there's not going to be money behind that, and so you think that's going to be an issue on the demand side for the economy. And then if you think that inflation is going to be persistent, you think that the excess savings that everyone has is going to juice the buying power for the next several years, and that consumers and businesses are already expecting this and are already pricing these ideas into their decision making. From a conclusion side, if you think it's transitory, price increases on the material side are going to subside. Production is going to work itself out, and demand normalizes, and we're going to get past this, and inflation is going to come back down to the target Fed 2% range. And the people in the articles that I've read about this issue, people are talking about that happening kind of like third quarter of next year. If you think that it's a more permanent issue, then you think these labor cost increases are here to stay, and this is something that we're not going to be able to shake off in third quarter of 2022. This is going to be, a problem for our business, or consideration for our businesses for a long time to come. So just it was a good infographic to kind of give the gist of both sides of that coin. So what's the Federal Reserve think about all this, right? So it's the Federal Reserve's job to, aim for maximum employment and keep inflation in check. In September, at the September 22nd meeting, the Fed said that they weren't going to move their target range for the federal funds rate. They kept it for between 0 and 0.25%, which is essentially zero. So there's no cost of capital. And then they kept their Treasury purchases to $80 billion a month, and their mortgage-backed securities purchases to $40 billion per month. If you guys recall, after the Great Recession, the Fed dropped their overnight rate to 0, and they were out of tools. And someone came up with the brilliant idea of starting to actually buy mortgage-backed securities, because this was a real estate-driven recession. The Great Recession was. That practice really hasn't stopped since then. And I kind of, just this is a side comment, but I kind of find it pretty interesting that when COVID hit, the Fed dropped the Fed funds rate back down to 0 immediately and kept buying mortgage-backed securities. The sector that during COVID that didn't need any help was real estate. Like we did not need, there was not a liquidity issue. There was not a demand issue in the capital markets for real estate. And so we've kind of like artificially kept juicing the real estate market through COVID. And I think that there are ramifications to that, and we'll get into that in a little bit. But this, the Fed has been really kind of evolving on this subject. Their opinion is an evolving one. So just 6 weeks later, at the November 3rd meeting, they didn't change their target on the Fed funds rates. They didn't change and then they in mid-November here, they changed their 80 billion a month to 70 and their 40 billion a month of MBS to 35. So they're starting to taper. They're starting to taper their purchases of mortgage-backed securities. And, just simple supply and demand. If the Fed is not buying mortgage-backed securities, that's, there's less demand for that product. And one would expect that the interest rates on those mortgage-backed securities then must rise for the balance of the players to buy all those securities and clear the market. And the Fed it issued in November that they're going to even further taper in mid-December to 60 billion and 60 billion of treasuries and 30 billion of mortgage-backed securities. So the Fed is now, though they haven't changed the target Fed funds rate, are tapering their treasury and mortgage-backed securities purchases, which is notable and will have an effect on interest rates and has already had an effect on interest rates. All right, so here's an interesting thing: the Freddie Mac forecast and mortgage bankers. What do they think? Freddie Mac's got a ton of economists. They buy a ton of mortgage-backed securities in the market. And the Mortgage Bankers Association obviously has a humongous vested interest in this issue. What's going to happen to mortgage rates being, the driving issue for us. And in October, Freddie Mac updated their forecast. Back in the summer, actually, it was interesting to note that Freddie Mac and the Mortgage Bankers Association had congruent forecasts in that they both were projecting, this was back in July, they were both projecting a 100 basis point increase in the mortgage rate in about a year's time. Which is a lot in a 1 year period. That's a significant movement, particularly given how low we started from. Where rates got down to this past August. But in October, Freddie Mac adjusted that, and so don't worry about the originations activity here because that's apples and oranges. These are comparing two different things. But in terms of kind of what the Freddie Mac economists are projecting for mortgage rates. Freddie Mac thinks that it's going to go up by about 50 basis points over the course of the next year, and the Mortgage Bankers Association thinks that it's going to go up about 90 basis points by the end of next year. So that's really, I think that that's an important and notable issue because of this slide. And so one thing that's important to consider is that given how low interest rates have gone, 100 basis point difference in the interest rate is a really significant, it's a 10%, as this graph illustrates, a 10% delta in your purchasing power. So if you were out this past August looking at houses and you had a pre-approval letter in your hands that said 480 grand on it, and you got tired, right? There's a lot of people who just got burned out by not being able to get something, and you circle back a year later and you have this, and you were in the same financial position as you were the year prior, but now the interest rate is 90 basis points higher, as the Mortgage Bankers Association thinks it's going to be. Your pre-approval is only going to be for 431, and so I think that that's going to be a problem because one, the psychological effect of no one wants to be the first one to get a higher interest rate that kind of just like cools the market just psychologically. Also, anybody who was shopping before was looking at $480,000 houses, and unless their financial condition has improved over that period of time, now they only get to look at $430,000 houses, and no one, just humans don't like that, right? Like they don't like test driving a BMW and then being told they can only buy a Toyota Prius like I drive. So I feel like that's going to have a cooling effect as well, and kind of a softening effect on demand because they just can't get what they want when they come back into the market. So I think I think those issues are something that we should be thinking about and considering as we do our kind of 22 planning as to what the market's going to look like next year. Let me bring up, this is a graph of the 30-year mortgage rate, the average 30-year mortgage rate in the United States from back to 1980 to current day. And what I want to just point out here is that for 40 years, we have been in a declining interest rate environment. No one watching this webinar has ever practiced real estate in an increasing interest rate environment. And that is something that I think everyone just needs to take a second and remember. We've got all of these fundamental assumptions because it's all we've ever seen in our entire careers as to how the market's going to operate. But the Fed has been, or a combination of market forces have been pouring gasoline on the American housing market for 40 years. And we literally can't go any lower. And so just keep that in mind. This is the same graph, but I just pulled it forward so that it starts in 2008 because I wanted to illustrate what a 100 basis point increase in mortgage rates means. Since 2008, just to kind of contextualize this post-recession, we really haven't had a period other than this little spot right here from 2017 to 2019 where mortgage rates moved by 100 basis points in a one-year period and increasing. And even when that happened, it came right back down. So we're about to experience, if the Mortgage Bankers Association and Freddie Mac are correct, we're about to experience an increasing, a quick, a relatively quick adjustment of interest rates in the wrong direction as it relates to affordability. So anyway, that's another data point that I wanted to take into consideration here. And take a quick breath. So Ivy Zellman, I wanted to introduce Ivy Zellman here. She is a real estate economist like John Burns. She's a consultant. I mean, I would say between those two, they're probably the two most popular real estate consultants for institutional capital, particularly for builders and anyone involved in single family and multifamily and housing generally. And Ivy kind of made her name by calling the crash back in 2005 when no one else was. And she's always been a little bit contrarian. It really kind of made her name when she did that. And her firm was just recently purchased. She's got a tremendous amount of institutional capital subscribers to her research. She and John Burns are considered the smart money in housing consulting. And she is in a class of one in that she thinks that this narrative that I've been reading and believing for the past couple of years, that there are tremendous tailwinds to real estate pricing because we're not building enough houses. Like that has been the talking points for the past 3-4 years, is that America is not starting enough housing, permits are down, the public builders haven't caught up, and we've got runway on housing prices because we're not building enough and the population is still increasing. She has, in a recent report, this report called Cradle to Grave that she put out, she's being pretty contrarian in that. And she's saying that the demand side of the numbers are skewed, and they're skewed by new players who've never been involved before. Frankly, all of the investor capital and private equity investor capital that's come into the market to buy houses that has never been there before. They've never really been market participants on the single family side to the effect that they are today. And when you strip those out and you just look at the real fundamental driver of housing demand, which is population growth and household growth, we are growing at anemic levels, 7.4% in population growth over the past decade and 8.7% on household growth over the past decade. And combined with kind of demographic shifts, that birth rates are declining, boomers are getting older, 20 to 39-year-olds are living with their parents longer, so household formation is delayed. And then they inherit that house when their folks pass away, so that a new household is never actually formed in that family. That if you overlay those issues versus current supply levels, we're actually overbuilding. It's a very contrarian view, And she's the only one, she's only popular housing economist that's really pushing that agenda. But she really only came out with this in the past like 30 days. And given her track record of calling the downturn last time and just kind of the quality of the research that their team puts out, I feel it's worth highlighting, because she's the one, it's, in The Big Short, they talk about like the people who actually looked into the data to see what was really going on, and they were the ones who figured it out. Like Ivy's the one who's actually like really digging deep in terms of household growth and population growth, and lining those curves up to see like, if we're actually producing. So it really gave me pause, because I've been saying for the past several years that there's such tailwinds to real estate pricing that, I would love to be contrarian, but I just don't see it. But when someone like Ivy Zelman comes out that direction, I think it's worth taking note. And so I'll conclude with this slide, just based off of those, and get into the Q&A and conversation side of things here. So one thing that I am concerned about, as I alluded to, is that rising interest rates are going to result in decreasing homeowner purchasing power, which will lead to, at a minimum, longer days on market. We're not going to see, I think that, we saw some softening from the summer to the fall in terms of, you used to have 25 offers on a house. Now maybe you have 5 offers on a house. And I think, maybe we still experience a spring demand, surge in demand, because it's spring and we're going to get back to cyclicality with, schools being in session and stuff. But I'm concerned that if you don't hit the spring, that maybe the summer and fall gets real soft, because we've experienced the full impact of those rising interest rates. So, as a takeaway for our businesses, this is going to be bad for flippers who are expecting pricing increase and maybe cutting corners on renovations, because it's a still very supply constrained market on the inventory side as well. So people are paying crazy numbers, being like, hey, I can just clean it up and it'll sell. Well, maybe now, if you get it on market now, if you get it on market in the spring, maybe. I get real nervous into summer, fall with that attitude, basically. Another issue being rising interest rates is going to, which has happened already. In the past 45 days, the 5-year Treasury is up 50 basis points. And that in a 45-day period is a lot. That's a lot in a very short period of time. And so that's going to cause increase in all of our cost of capital when we're borrowing from banks or non-bank lenders. I'm expecting, well, we're already seeing that mortgage rates on like rental loans are starting to creep up, and bank rates are starting to creep up because the 5-year Treasury is moving up. And so that rising interest rates is going to, in the short term, lead to decreased spreads between net operating income and our cost of capital. So we're going to get squeezed a little bit as landlords, I think, which is bad, obviously, until rents catch up, right? One of the nice things about owning hard assets in an inflationary environment is that if there's inflation, that generally is correlated to rising incomes, which should allow for rising rents, higher rents for landlords able to charge higher rents because their tenants have higher incomes. Now, it's important to point out there that that's like on a stabilized basis, right? But like the real world doesn't work. Like it doesn't like adjust. The market doesn't adjust and come to equilibrium every single day. And so there's, if you're trying to push rents, but in your region of the country, incomes aren't increasing for some other demographic reason, well, then you just have, you just have higher cost of capital and you don't get the increasing rents. So make sure that you're not like just, thinking that, thinking that the market deficiency is going to bail you out. There are regional and local differences in, in economies. So keep that in mind and don't just think that like, oh, I'll be able to increase rents next year and make it up then. Maybe, but maybe it's a couple years from now. Another issue that I think is true, whether you were in the transitory camp or the permanent camp, but especially in the permanent camp, supply chain issues are still far from over. The truck drivers have been in the news a lot over the past month, and that is still causing delays. Now, in seemingly in different aspects of the building process and renovating process, every month there's a different thing that's backed up. I think it's garage doors right now, where they're like it's on a 16-week delay. But that issue is going to be bad for anybody who's renovating properties, flippers or landlords. So don't think that that's over yet. I think by the best case scenario, it's third quarter of next year. But until then, don't think that your renovation is going to just run super smooth. You're going to continue to have disruptions. And then I think we're going to have longer days on market next summer and particularly beyond that, which is also bad for flippers for obvious reasons. So in terms of like takeaways, for your 2021, 2022 strategy and a 2021, 2022 strategy, because we're going into an inflationary environment, I'm a huge fan of owning hard assets. So we continue to buy rental properties as quickly as we can. I do think that inflation or, rents will increase in an inflationary environment. So I do, sleep well owning hard assets as opposed to being in securities or cash. But a strategy on that point is, refinancing your bank loans into a 30-year rental loan. This is my shameless plug in the podcast for our lending business, because we do an excellent 30-year rental loan at lower than bank rates and for 30 years fixed. And so if you have any bank debt that's going to come up in the next 5 years, we are refinancing all of our bank debt and putting it into 30-year loans, because I do not feel comfortable about where the yield curve is going to be 4 years from now. And if we lock in today's very low rates for 30 years, I've locked in the win. I feel like, especially if I have any fears of inflation, short-term or long-term, locking in today's low rates locks in the win. So we're a big fan of that. We have 750 houses. We're literally in the process of refinancing every single one into the product that we lend to investors every day. And then additionally, be cautious about calculating your flip margins. Continue to factor in supply chain delays and increased sale days on market. Your skinny flip. Last year, you got lucky, right? Like last year, everyone got bailed out because the market went up by literally 15%. If you lost money on a flip this last year, you should don't do another deal, because you had a 15% tailwind last year, and it's not going to happen this year. I just don't think it's going to happen this year for all the reasons that we just talked about. So I think that that's going to cause some distress in folks who are playing with house money and are like, hey, I just need another deal. And they buy a skinny deal, and this time they're not going to have a 15% tailwind. And so, think about that before you go double down on the next one. Maybe you just, take your chips off the table and say, that was great. Glad I got lucky. Or spend the extra time and find a deal where the numbers actually pencil, given these concerns and these risk factors. And then I've said this already, but keep watching for rental purchase opportunities, because in an inflationary environment, being in hard assets is a great place to be, particularly relative to everything else that you might be in. So we're continuing to do that ourselves. So that is it. That is all I've got for you guys today. Came in at half an hour, not bad. Appreciate everyone's patience listening to me talk for the whole time. Got a couple folks here in chat.
Hey, Jack, this is Rachel.
Hey, Rach.
I just wanted to step in here and help you with the hand raising. So we have a question from Austin Carroll. So Austin, I'm going to request that you unmute yourself, all right?
Cool. Can you guys hear me?
Yes, sir.
Cool. What's up, Jack?
How's it going, bud?
Thanks for putting this on. Question about rates. I mean, a lot of what we talked in there was the Fannie Freddie stuff. How specifically does your all's product, which another plug, we've recently used you guys, and fantastic. So excited to keep doing the same thing, refine a lot of our assets into that product. But how do you see those rates tracking? Is it like, if I see Fannie Freddie going up, should I assume that those are also, or do they take a little bit longer with those investors, or how's that work?
Yes, that's a great question. The loans that we are making and other non-bank lenders are making that are being sold into the secondary market, which are great right now. The rates are still in the 4s for 30 years fixed. but they track with the 5-year treasury, which is weird, right? Because it's a 30-year loan. So why the hell does it track with the 5-year treasury? The reason for that is that Wall Street is using historically looking models at prepayment speeds on these bonds. So these loans get securitized and sold as bonds. And then institutional investors like insurance companies and pension funds buy the bonds. Well, over the course of the past 10 years, in a declining interest rate environment, those loans only stay on the books for a weighted average of 5 years. So they've become accustomed to now thinking that, oh, it's a 30-year loan, but it's really a 5-year bond that I'm buying. Now, I don't really agree with that approach personally, because we've been in a declining interest rate environment. And so there has been an economic incentive to refinance every 2 years because the rate got better and better and better and better. And I don't think it's getting better over the course of the next 10 years. And so I just don't think that the prepayment speeds on these loans are going to be as fast as they have been. And so while the bond market is pricing these off of 5-year treasury, I think they should be pricing them off of 10 or 15-year treasury. So frankly, there's a little bit of if you drink that Kool-Aid, then there's a little bit of a gaming the system that can happen right now. Because if you know you're going to hold this property and hold this loan for longer than 5 years, well, you're actually getting over on the lender, because they should be pricing you off of the 10-year treasury, the 15-year treasury, but they're pricing you off of the 5, which is cheaper. Another reason that we're refinancing our entire rental portfolio is that I'm not selling these things, I'm not prepaying these loans in the next 5 years, but I'm getting a bank rate, but I'm getting a loan rate that thinks I am. So anyway, yeah, watch the 5-year to get a sense of how this market's going to move. Cool. Thanks for that question. It was a great question. Okay, Alexi. Hey, what's up, Alexi? Do you think that price increase for single family housing driven by stimulus money and lack of spending due to COVID, or is it more driven by lack of inventory? Oh, that's a great question. I think that the declining interest rates has been a big piece of that. If we go back to this.
But I think the broader question is, what do you think drives, why is the lack of supply? You know, I mean, is it lack of supply? What drives the prices, right, in the first place?
The supply so I mean, people are staying in their houses longer. Household formation is delayed. I think those are the two biggest drivers, and people spent the time during COVID, you know, people didn't really want to be moving around as much during that. And so they spent that time investing and making the place where they're living currently nicer. And I feel like that also kind of delayed things. I'm also concerned that, you know, if interest rates start to increase and you refinanced over the course of the last year or two, no one wants to, like, you know, you're gonna be forced to give up your 3% mortgage rate and go borrow on a different house at a 4% mortgage rate. You know, there's inherently a trade down there that unless you're actually a boomer who is downsizing, like, you know, you won't be moving up to a nicer house, or you might be, but you're not as nice as it would be if you didn't have to give up some room on the higher interest rate that you're paying to get into that house. So it's, you know, having this 30-year fixed rate mortgage at 3% is an asset, right? Because you get this really super low payment, and you can't replace it if you buy a house 5 years later and rates are at 4.5. So it's like, in addition to the house that you're giving up this cheap mortgage asset. And I think that's going to delay, or I think that's going to temper moving as well. And then lastly, kind of given as much, one more thought on that is that given as much as the world has become a bit more tolerant, or a lot more tolerant of work from home, and that the job market has become much more work from home. I don't think people are going to have to move for jobs as much as they had to in the past. And so that may also temper movements, you know, like, you know, it used to be that on average, Americans moved every 7 years. That's been elongated, or 5 years now, that's been elongating out to like 10 now. And I'm afraid that it's going to go even further.
So I guess I'm trying to get at, so obviously with raise of the interest rate, like the purchasing power going to be decreasing, but if we're not going to see additional supply, hopefully it a little bit counterbalance that. I guess the question was, when we're gonna see if supply now will be at the level which we see before the COVID, we will be screwed, right?
Yeah.
Yeah.
Yeah, 100%, 100%. I totally agree with that. And I think that that issue is correct until you get to affordability, ceiling. You know, like if incomes don't go up fast enough to deal with that issue, like there is a certain point at which they just can't make the payment. And, you know, we get closer every year to that issue. My 2 cents.
Thank you.
Cool, man. Great to see you. Oh, this is a question from Sam Lewis. How would you compare the fragility of the greater Baltimore market compared to the rest of the US? It's a great question, Sam. So yeah, we're here local in Baltimore. There's a bunch of folks who are on the webinar here from Baltimore. Yeah, but I mean, Baltimore, I'm attending there's this presentation, economist presentation, this guy, Anirban Basu. I'm a big fan of him. He's an economist. He's another housing nerd. He does more broad economics as well, though, but he always speaks to the housing market. And so he's giving a presentation actually next Tuesday at it's a ABC of Greater Baltimore presentation. It's the 2021 State of the Industry that's Associated Builders and Contractors. If you can attend that, it's up in Pikesville next Tuesday. Just Google ABC Baltimore, Anirban Basu, Anirban. And anyway, so I'm really interested to hear his take specifically, because he's very much, he studies exactly what you're asking, is like, how's Baltimore going to do relative to the region, relative to the country? And he talks about all the interesting Baltimore issues. Certainly the Northeast continues to have not as great of population increase as the South and the Southeast particularly. And so we don't have the tailwinds of household formation due to domestic immigration that other regions in the country have. And so we always struggle a little bit, right? Like it's a victory in Baltimore if the census doesn't show a decrease in population. So not great, like not ideal. But I'm going to go to this presentation this one's a little bit above my head. So after this presentation on Tuesday, maybe I'll have something more interesting to say and I'll circle back with you, Sam, but appreciate the question. And then Joe Farias, hey Joe, says it appears that the way to go moving forward is to focus on creative financing with options, short sales, subject to seller carry wraps, owner financing. Yeah, that's a really interesting idea because there was a long period of time where, I hear these stories from older real estate investors who were doing real estate back when interest rates were 16%. And they talk about how they never worked with the bank. They were able to structure their own creative deals and work with sellers to replicate financing because going to the bank was, cost prohibitive or just, wasn't worth it. And so I wonder if I'm not sure that, interest rates going from 3 to 4 or 5 or even 6 or 7 are going to make it so that it's, that the industry becomes unbankable or much less bankable. But I do think that there's going to be more opportunities to work with sellers who, like, as I mentioned, do have this asset of this really low financing. And that becomes actually an asset to the deal. So like to your point, like subject twos become really interesting when you can approach a seller who maybe has a little bit of equity, but they do have a 3% mortgage rate. And that's something that you can't replicate anymore because mortgage rates are now 5. Those subject to deals start to be able to pencil a lot easier. So yeah, I think creative stuff going forward is definitely good tools to have in the bag. And then one other thing you just made me think of, Joe, that we didn't really touch on here is just, inventory in terms of kind of like upcoming foreclosures. Right now at the courthouse steps, we monitor like 8 counties and I'm just talking about Maryland here, but we monitor like 8 counties in Maryland. And we've seen an increase in the number of properties at the steps, and there was a little spike a month or 2 ago, but then it's kind of come back down. And we've not seen the kind of the flood of sales yet that one might have expected. I think there's the lenders are really trying not to foreclose. There's a lot more infrastructure in place for foreclosure prevention today than there was back in 2009, 2010. And then certainly the court systems are working against those judicial foreclosure states in terms of processing how quickly that's going to happen. So the conversations that I've had with folks make me think, who are closer to that pipeline, make me think that in the first quarter, we're going to start to see some more inventory, but it's going to be far from a flood. There'll be more, but it's not going to move the market. No one thinks that it's going to actually drive price decreases. But certainly, to Alexi's point, any source of new supply is better than where we're at right now. Then Kiki, hey Kiki, says, I think house prices have to come down before a huge flood of foreclosures because people may have lost their jobs and have not been able to pay their mortgage, but it still seems like they have equity. Yeah, absolutely. Particularly with 2 years of such incredibly high home price appreciation. I think 2020 was like 10% or 11%, and 2021 was 15%. So yeah, if you were in trouble before, or whether you're in trouble or not, the market, put a huge tailwind behind you and maybe pushed you above water. Even if you have a cash flow situation, you probably have equity at this point. And so I agree, that'll also temper the amount of foreclosures because people can just sell and get out. And then a follow-up. Any thoughts on all the institutional liquidity chasing the single family house built to rent communities now being built in mass? John Burns is like the expert on this particular subject. He's one of the consultants that the institutional capital who is putting money into build to rent really follow. He's very, very bullish on build to rent he thinks that the fundamentals of like how Americans are consuming housing really are congruent with these build to rent communities. I'm super curious to see how you can put so many units into one area, and particularly in the regions where this is very popular, where it's very easy to build, like the Carolinas and Georgia and Florida and Texas and Alabama. How do they, institutional capital tends to shove a bunch of capital into the market and then not quite get it right in terms of being able to balance supply and demand. And so they constantly swing back and forth to oversupplied, undersupplied, oversupplied, undersupplied. And given that there are like significant regional differences to how quickly you can put new lots into the market, like in Maryland, you're not going to oversupply the market because it's so hard takes so long, it's so hard to develop land here versus the Carolinas or Georgia or Texas or Florida, where you can really shove a lot of inventory into the market very quickly in those markets. And so I'm pretty skeptical that they're going to get that balance correct. There'll be winners, and I think that if you don't get your product on the market in time, and your area gets overbuilt, that you could find yourself in an oversupplied market with softer rents. So that'll be a fun one to watch. But if you want more information on that, John Burns' research he's the man as it relates to build to rent. Austin, do you think crypto will play into any housing market factors? I don't know anything about crypto. I don't know a thing. Sorry. We'll have to do another webinar sometime. You should send out a crypto webinar as it relates to housing, and I will hop on it to learn because I don't know a thing about it. I'm a hard assets real estate guy. Sorry. Cool. Thanks, Kiki. Any other questions from anyone? Feel free to raise your hand or shoot a text into the chat. But either way, we're coming up on 45 minutes here. So on a Friday afternoon, I know that's about as much attention span as I've got. But happy to continue the conversation with anybody. Otherwise, really appreciate everyone tuning in and enjoyed the conversation and feedback. And hope you guys found it helpful and have an excellent and very successful 2022. Oh yes, Sam, you said, do you think we're on track for loans to go to a 35 to 40 year fixed rate mortgage similar to Canada and the UK? That's a great question. I don't know enough about that. I should know more about that. I'll have to do some research on that and formulate an opinion. The 30-year mortgage, has become a sacred thing in American housing. So I'm kind of skeptical that the markets will move away from it. Also, like when you get beyond 30 years, in terms of the amortization schedule, you're really not getting much principal reduction. So it gets closer and closer to an interest-only loan profile. But I could see that, going to those longer amortization loans is, it helps from the affordability point of view. Doesn't help as much with wealth creation, but it helps from affordability point of view. So maybe that's a strategy for that. All right, guys, I think I'm going to wrap it up. Really appreciate everyone tuning in and the great questions. Really enjoyed the conversation, and I hope that everybody found it useful. So have a great weekend. Enjoy yourselves.
Thanks, Jack.
See you guys.